Netflix reported more steady growth in Q1 as it transitions to maturity, but from advertising to gaming and live sports to video podcasts, Netflix is staying opportunistic. Listen on.
Welcome to this week's edition of Inside the Stream. This is Will Richmond from Video News, and Colin Dixon from In-Screen Media is with me. Colin, how is everything for you?
It's going great, Will. After the record temperatures in March, we are back to our normal weather pattern. So we're actually getting some rain this week, for which we're very grateful because our snowpack is nowhere.
Yes,
So,
I've heard.
Pretty happy about that. But this week, we're going to talk a lot about Netflix this week. And I tell you what, Will, I am not anybody to listen to about investing because I do not get what the investment experts say. They're all upset with Netflix's Q1. They're saying because Netflix didn't raise their guidance for 2026 from 50.7 to 51.7 and the full year operating margin of 31.5% came in below 32%. That's just 0.5%. They've driven the stock down by 16%, $15 or something. It's crazy. I don't get it. Netflix's results were, I thought, pretty good. They increased revenue 13% year over year for the quarter. I mean, geez, getting that sort of growth in this market is pretty good, right?
It seems pretty good, but I mean, I think, and I'm not going to shed any light on how investors make their decisions. I think we can agree that it's a pretty opaque process. But, we do have to remember Netflix has been a darling, and they've been a high growth company for years and years and years. They've delivered on that growth, and they're a very different company. You're going to talk about the results for the first quarter in a moment, but their story is more one of stability right now rather than rapid growth.
Yeah, it definitely is. And if our listeners are looking for stock tips, they shouldn't be looking here. Anyway, let's talk about some of the results. One of the things that Netflix has done in the last couple of years, of course, is they've stopped giving us any subscriber numbers. They don't do that anymore. Well, they did this quarter in the earnings call. Greg Peters, who's one of the two co-CEOs, he said at the end of 2025, they had 325 million paid subscribers. So the last time they gave us a number was back in Q4 2024 when they said they had 301.6 million subscribers. So that's about 8% growth in 2025, which is pretty good for what we all should consider to be a pretty mature company. So that's interesting right there. They also said that they gave some interesting metrics, which I'm still processing. They said that from an addressable household perspective, that they are doing pretty well. When they talk about addressable households, they're talking about households with a smart TV. They didn't define the base very well here, Will, but I guess it's still kind of interesting. They say that they think they have a 45% penetration of homes globally with a smart TV. They say they reckon about 800 million homes around the world have a smart TV. And so if they're really 45% penetrated there, doesn't quite add up. That sort of implies 325 million, 45% implies 720 million, but I guess we'll give them a little bit of inaccuracy there. The bottom line here is that they're very deeply penetrated in smart TV homes. They also said that this is a really interesting one, Will. I don't know how they calculated this. They said we've captured 7% of addressable revenue, which he claims is 670 billion worldwide. And this one actually adds up a little better. 7%, if they're 7% of revenue, they earned 45 billion last year. So that implies 643 billion total. So that's a substantial amount of the addressable revenue. Now, we're not sure what's included in that addressable revenue, but one presumes at least SVOD and the advertising therein, whether it includes fasts and traditional pay TV. I'm not quite sure. I'd have to go back and look at some other numbers to validate that, but that's an interesting number. And I got one more claim that they made. Well, they said, we estimate that we account for only 5% of TV share globally. But one company accounting for 5% of global TV viewership, I'd say that's a pretty decent achievement.
Absolutely. And other than YouTube, Netflix is certainly the most global company in the streaming space. So 5% is a pretty nice achievement for them. And of course, it was just about 20 years now that they've been in streaming. So
that's right. 20 years. There was one little bit of bad news when I ran the numbers. Remember Netflix puts out this thing they call the viewing report. And they said that in the first half of 2026, that's not 2026, that must be the second half of 2025, because we haven't done the first half yet. They delivered 96 billion hours of viewing. And back in 2024, in the first half, they delivered 94 billion. Now, if you divide out, now they've given us a number of subscribers. I can come up with a number per subscriber. And so back in 2024, each paid subscriber was watching about 1.9 hours on average per day. And today that's 1.6. So that's down 15%. So, that's not a good trend. And that's a trend I noticed a couple of years ago, that they were seeing decreased engagement. And I think maybe that's something else that maybe investors are a little bit worried about, but it is a more competitive market.
Well, and just to add the converse of that, they, in their letter, talked about the engagement metrics that they follow and said that in Q1, they had made, quote, good progress as our primary internal quality metric reached an all-time high. They didn't necessarily define exactly what that metric is, but at least, from their perspective, it seems like they feel like they're chugging along in the right direction.
They certainly do, and interestingly, they've just stuck through this quite substantial price increase. Gregory Peters still thinks that Netflix is great value for money. He says, as a comparison point to support their price increase in the US right now, Netflix subscribers are paying the least per hour of viewing compared to other SVOD offerings. So in some cases, you'd have to pay 2 times per hour more, I guess, to get a competitive service. And certainly looking at the data that I've seen from companies that are measuring engagement in the different SVODs, I kind of believe that number. They're typically being watched twice as much as, say, Disney Plus or Paramount Plus or one of the other services.
I think that's right. The $9, we'll talk about the ads tier side of Netflix in a moment, but that $9 ad plan, standard plan with ads, I think is the best value out there. On the paid side, you could argue that the best value out there is YouTube, the free version of YouTube, because there's just no place where there's as much content as there is on YouTube and everything else. But, when you get into the SVOD side of the world, that's a bargain, even with the $1 increase that they just put through recently.
Yeah, I think it is. And we were chatting just beforehand, they're bringing additional value to the table. They're gaming that they've been investing in. I've found some games that I really like, and it's nice to play games that don't show bloody ads all the time. It's really nice. So, there's other value here. But you mentioned ads. What's going on with ads? Yeah,
so let's talk about that. They said in the letter, and they've said this in the past, obviously, that advertising is a major monetization priority for them. They observe that 60% of the signups were for the standard plan with ads in the countries that they offer an ad-supported tier. It now seems like there are a dozen countries that where Netflix does offer the ad tier. I actually thought it was higher than that, but that's on the FAQ for the standard with ad tier. That's what they say, just 12 countries around the world now. They did say that they're forecasting $3 billion in advertising revenue in 2026, double what it was in 25. But when you compare it with that 50 billion plus of revenue forecast for next year, it's still only around 6% or so of total revenue. So advertising is still a relatively small piece of the puzzle for Netflix, even though it seems that when it comes to attracting new subscribers, that is now the preferred plan. And certainly the difference between the ad plan at $9 per month and the cheapest standard plan without ads, which is $20 per month, that $11 differential, I think, is the biggest in the industry for SVOD companies that offer an ad-supported tier as well. And as we just said before, that $9 a month is, I think, a fantastic value. The ad load, I have the ad plan, the standard plan with ads, and the ad load is so small. I mean, it's barely noticeable. It's, for sure the ads are there, but it's a very lightweight experience. So I think they have, and I think it's borne out in the numbers, but I think they have a hit with that standard with ad plans. Ironically, of course, Inside the Stream listeners will remember that there was a long, long period of time where Netflix resisted the idea of rolling out plans with ads included. They insisted that they were meant to be an ad-free service. And now that they finally launched it, it seems like it's going along pretty well for them.
Yeah, it certainly is. And you're right. They do have the biggest ad-free viewing penalty in the industry by far, Will. It's $11. The next closest is HBO Max with $7.50. So that's a big difference. That's much, much smaller difference. And Disney Plus and Hulu, the difference is $7. So they're definitely charging a premium. And I was just trying to get some data on CPMs, what sort of CPMs Netflix is seeing. Remember when they launched, they were asking for $65, and I was looking at some DigiDay data, but it's a couple of years old. They said that they had rapidly had to drop that into the high 20s, I think, or mid 30s. So I really think they're overcharging us ad-free viewers. I don't know why they're so intent on pushing people into the ad plan, because with such light loads and, not cheap CPMs, I doubt that they're making up that $11 difference with the ad viewers. But no way to know because they don't give us that data.
Well, I can offer one explanation for why they're doing it, which is that we know from the antenna data that the growth in pure non-ad supported subscribers across the entire streaming landscape has really slowed down, and that the majority of new subscribers in the last number of years across the industry has come from these cheaper ad supported plans. So I don't know, you mentioned the word penalty for the premium tier. I don't know that I'd characterize it as so much as a penalty as that it's an inducement for those still on the sidelines after all these years of not subscribing to come on board. And I think it's a smart strategy because it gets people in the door, and hey, if they really don't like the ads, even at the light load, then they can step up for another $11 per month.
No, you're right. You're right. It's just I guess it's just, for me, personally, it's a penalty.
You feel, well, that's fair. I'm not.
I feel penalized, and I suspect a lot of other people do as well who are like me.
Understand.
Being a subscriber from the moment they launched. Actually, I was a subscriber. Did you subscribe to the CD plan? Yeah, you probably did. We both did. So we've been decades in this, and I don't know. I guess I feel like we should be getting a bit of a break, but maybe not. There was one.
Take your complaint to City Hall, as they say, Colin.
Yeah, indeed. So there was another bright area, I think, for them this week. S&P Global Market released some data talking about how successful video podcasts have become in the US. They said that, in fact, that a significant portion of podcast users, that's audio and video podcast users, are consumers of video podcasts on YouTube. In fact, they say 62% of those guys are also watching their video podcasts on YouTube. So I suppose it's no big surprise, right, that YouTube would be so successful in this space. They're very successful. They're the most successful video service in the world, and certainly in the US. But the interesting thing was that they gave the sort of runners-up. That YouTube is the gorilla, but they gave us some of the chimpanzees. And top of the chimpanzees is Netflix, according to them. They say that about 34% of podcast users are now watching video podcasts on Netflix. Spotify is number 3, 23%, and Apple TV is back at 11%. And obviously podcasts in general is an area that Apple is super strong in. Lots of people are using Apple to listen to their podcasts, and Spotify as well. But I guess in this particular area of video podcasts, we've got Netflix with their huge reach just doing extraordinarily well. So, oh boy, I'm sorry. We've got a car horn going off in the background. I apologize for that noise. They said one other sort of data point here that they threw out was that around 60% of US online adults are regular podcast listeners. So that's about 160 million Americans. So this is an area that they've only recently entered, Will, you remember. And Ted Sarandis, actually in the call, was pretty positive about it. He said that there were a couple of things that he really liked about the podcast, principal of which historically Netflix, most of Netflix viewing has taken place in the evening when people want to sit down and watch something great on TV. But the podcasts are getting viewed more during daytime hours, which is an area that he thinks that they're weaker in, and also on mobile. So those are two areas that Netflix was looking for help for growth in, and it looks like it's been very successful for them. And they also said that they're producing podcasts, and I remember they said that they were doing this, but he gave a little bit more detail. He says they have podcasts called The White House, The White House, and from Peter Davidson Show. We have companion podcasts for super fans like the Bridgerton official podcast and a few others. And he also went on to say, we announced new podcasts from Brian Williams, from Evan Ross Katz, Stephen Su, Ellison Barbara, David Kwang. So the list keeps growing and it's very promising. So this is, S&P Global Markets is saying that this is now a very significant market growing really fast, and Netflix is right there.
Yeah, we've talked about this before. We both like the video podcast strategy, low cost content for Netflix, drafting off of the popularity that audio podcasts by some of the creators you just mentioned, the audience that's been established. So they get that tailwind on that. Inexpensive to produce, and to your point, brings in viewers at a different day part than the traditional Netflix entertainment service was all about. So I think it's a winning strategy for them, and I would expect that they're going to put even more resources into it going forward.
Yeah, me too. But they had one more piece of news, and I'll let you tell us what's happening with the ex-CEO.
Yeah, end of an era. Reed Hastings, co-founder, stepping down from the board after all these years. And, huge accolades from Netflix on the earnings call well deserved. Also, we were talking before the podcast started that there are only kind of a small handful of people that are as responsible for where we are today with streaming as Reed Hastings was. And, we think about all the steps, all the strategy and the execution steps that have occurred over the last 20 years or so since Netflix got into streaming. And that's on top of obviously the success that they had when they were still shipping DVDs around. But all the streaming success that they've had, starts with the leadership and goes on down. And of course, they have not been perfect. Quickster, obviously, probably the biggest blunder along the way, but they recovered from that and, are the market leader globally, as we just talked about. So got to give Reed Hastings a lot of kudos.
Yeah, I can't think of anybody else that's had any single individual that has had a greater impact on the television industry in the last 30 years. I just can't think of anybody else. He alone, I think, has driven the industry towards SVOD, proved it could be done, proved he could build a company with global reach, delivering quality content to tens, hundreds of millions of people worldwide. What an achievement.
Yeah, absolutely. And then just a couple other quick to round out the Netflix story this week. It looks like they're going to take on some additional studio space in LA. Deal reported for the Radford Studio Center in LA, like $300 to $400 million. That's a shot in the arm, I think, for the LA creative community, which has been reeling ever since COVID and the decline of peak TV. So they get a shot in the arm, I think, with the Netflix, a greater commitment to the LA production scene.
Yeah, that's absolutely true. And with that thought, Will, we talked a lot about the Warner Brothers Discovery bid and the fact that we thought that they were a better home, that it would protect the creative community better, we thought. Well, there are rumors now that Netflix is quietly behind the scenes undermining the bid by Paramount Skydance for Warner Brothers Discovery, trying to make it more difficult for that deal to go through, forcing maybe Paramount to give even higher guarantees. And well, do I believe it? I totally believe that they're doing this behind the scenes. Why would you not if given the opportunity? So I totally believe that.
Yeah, I'm not sure what I believe, but there's certainly a benefit to Netflix stirring the pot behind the scenes, because the more that they're able to get Paramount, Skydance to commit to doing post acquisition, the more competitive a position that Netflix will find itself in. For instance, the commitment that they just made to, I think it's either 30 or 35 releases per year, and also the theatrical window. Every time they make some type of commitment like that, it just gives Netflix another advantage, because they retain their flexibility to do whatever it is that's best for the market opportunity. Mm-hmm. So can't say that I'm 100% confident that they're behind it, but certainly benefits to them stirring the pot.
Yeah, I'm sure. And one last, I guess, positive thing I wanted to just mention. We know that Netflix has a very specific strategy with their live sports. That is, they're really event-based rather than buying entire leagues. They had a big success, apparently, with the World Baseball Classic, which they actually licensed exclusively in Japan. So this is the first time they've done something like this, where they've licensed a live event for one specific region. Well, apparently it went really well. They said that this massive event delivered 31.4 million viewers, becoming 3 of our most watched programs ever on Netflix in Japan. But they went on to say that it sparked the largest day of signups in the country. And I bet that's a lesson that they are going to take to other markets, Will. You get an event in a particular sport that reaches a demographic that they're weak in, they're going to start going after those. And I have a forecast for you. Not a forecast. If I was them, I will be looking to partner with NASCAR on some sort of event in the US. I bet that will be very advantageous for them here.
And why not talk about the Super Bowl on Netflix at some point also, right? What service will get the Super Bowl first? Let's say Netflix, YouTube, or Amazon. Where would you put your bet?
Oh my gosh. Amazon? I don't know.
Yeah.
That's a big one. I don't know. I don't know when we'll see that.
I would say never, but yeah, I would go with Amazon or YouTube before Netflix. But
yeah, me too.
Conversation for another day. I think we've covered the Netflix story pretty well. They continue to chug along, right?
They certainly do, and they're thinking long term. So I guess they're happy for the investor advisors to think short term while they continue to think long.
Yeah. Well, we'll leave it at that, Colin. Good chatting, and thanks everyone for listening in on this week's Inside the Stream, and we'll see you all again next week.
Inside the Stream is a production of In-Screen Media and Video News, all rights reserved.